In this video, I'm going to share with you a 0-day option trade, but this one's special with a surprise twist. If you're not familiar with what a 0-day option trade is, watch this video and I'll explain it to you. And then see if you can catch the surprise twist. Did you know that I host a free user community of stock option traders just like you and I? It's where we all share tips, tricks, hints, and secrets about trades we're currently doing. It's a friendly and helpful user community for new and beginning users to learn how to trade stock options so that they can generate a regular weekly or monthly income. We share tips, provide helpful information, and I even have a classroom available with helpful information to walk you through learning about selling covered calls and cash secure puts. You'll also get exclusive early access to my trading videos before I post them to my YouTube channel. Now, who wouldn't want that? So be sure to head on over to school.com/simpleoptiontrading. I'll leave a link in the description down below. Hey, and did I mention it's free to join? So let's just jump right into the middle of this trade by using my special covered call analyzer. Now let's take a look at the covered call analysis to figure out the profitability of this particular trade. So today's date is August the 22nd. The stock symbol is for energy transfer, so that's symbol ET. And for the expiration date, I'm going to be using the same date as today. And so this is what gives me the 0 days to expiration. Now strike price is $17.50, and the premium that I'm specifying is 18 cents, and my cost basis is $17.52. So right away, a lot of you will say, hey, I've got it backwards, or I did something wrong. Because normally what happens is your strike price should always be equal to or greater than your cost basis, right? So this strike price is $17.50. My cost basis is actually 2 cents per share greater than that. So normally I would not recommend executing this trade, but this is an unusual situation where I believe it's okay for me to do this and go outside the normal rules because this can still be a profitable trade for me. So I'm not recommending that anyone else do this, but for me in this particular case, because of the situation, I am going to execute this trade where my strike price is actually below the cost basis. This is not a normal practice, so don't normally do this. All right, let's take a look at the numbers for this analysis. So this is a covered call for stock symbol ET, where the current market price is $17.51. Now I've got 100 shares, so I'm going to be selling one contract, and the current value of those shares is $1,751. Now, because I picked the expiration date of August the 22nd, the length of this option contract is going to be 0 days, because today is August the 22nd. So I'm in the morning of the 22nd, and because there's 0 days left, this is why it's known as a 0 DTE, or 0 days to expiration. Now for my strike price, it's $17.50. I want 18 cents per share. Now because my cost basis is $17.52, if this option contract gets exercised, I'm automatically going to lose $2 as a result of this trade, right? So I paid $1,752 for those 100 shares, but if the option contract gets exercised at $17.50, I'm only going to receive $1,750, and that difference is $2, or negative $2. Now when I sell this option contract, I will receive $18 as the premium payment, and that's going to represent just over 1% based upon my cost basis for these shares. And keep in mind, this is a 1% for a 0-day trade. So let's say that this option contract gets exercised later today, and I do get my shares assigned to the buyer. I receive the $17.50, so I'm going to lose $2 off of that. And then the total profit for me is going to be $16, right? So it's the premium $18 minus the $2 that I lose from the price appreciation. So my net is only going to be $16. But as you can see, my total profit is just under 1% for this 0-day trade. So even though I did specify a strike price that was 2 cents below my cost basis, I did decide to execute this option trade. And so here we can see that I sold a covered call for stock symbol ET with the strike price of $17.50 and an expiration date of August the 22nd. Now I submitted the order on August the 22nd at 7:29 a.m. and you can see that it was filled 7 minutes later at 7:36 a.m. Now when this option contract got filled, I specified 18 cents per share as the premium, which means I received a total premium payment of $18. Well, now let's jump over to Yahoo Finance and take a look at what happened at the closing bell on Friday, August the 22nd. Here we can see energy transfer symbol ET on August the 22nd at the closing bell. Closing price was $17.51. So it's 1 cent above my strike price. And so that means that my option contract did get exercised. my shares were assigned and I received payment for my shares of only $17.50 per share. So I received $1,750. So my net for the price appreciation is a minus $2, but I did receive a premium payment of $18 when I initially sold the option contract. And so my overall net from this option sale is $16. So even though it seems a little counterintuitive to me to actually pick a strike price that's below my cost basis, but looking at the net effect, I lose $2 in price appreciation, but I walk away with $1,750 in my pocket as reimbursement having my shares assigned. And now I can take that cash and redeploy it someplace else where I think I can make a better return on my investment. In this video, I shared with you an option trade that had 0 days to expiration, or 0 DTE. When I have more trades like this in the future, I'll be sure to create videos and share them with you here on my channel. Thanks for watching. I hope to see you in the next video.